Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about CPP, and I know we've done a lot of videos on CPP. This one's a little different, and it's requested from so many of you. So, we recommend, for the most part, delaying CPP till 70, or at least, not taking it at 60. But a lot of you have said, well, what if we take it at 60 and invest it? Then I have control of it. I feel like I'm getting it. A lot of you make comments that, as soon as I hit 60, I'm taking my CPP. I've paid into it for too long. What happens if I die early? I want my money. And I totally get that. But at the end of the day, we're a financial planning channel. So my job is to bring out thoughts and concepts and ideas around financial planning. So, when we run the hard numbers, usually delaying CPP, maybe taking RRSP a bit early makes the most sense from a numbers perspective. Of course, I've always said here too that, retirement planning and income stream is really a huge psychological shift. So when you shift from a paycheck to a playcheck and start paying yourself out of your accounts, including CPP and OAS, a lot of the times the thought process is, I've paid into this for so long, I just want to start getting money out. I know it's not the maximum I can get, but I just want to get something. And again, I totally get that. But so let's run through a scenario where instead of delaying till 65 or 70 to take CPP, let's assume in this example, we're using a 59-year-old couple. They've saved a bit of money. So they both have RRSP accounts of 300,000 and TFSAs of 120. So they have a bit of assets. They're not putting anything away at this point. They're 59 years old. They plan to retire at 65, but they thought, let's look at taking CPP at 60 and investing it. Okay, so they both make $70,000 a year of income. Okay, so that's their data, and we'll jump into it here in a second. But what I want to look at is, instead of taking CPP at 65 when they're going to retire, what happens if they take it at 60 and invest it into an RRSP? So we're going to assume they have RRSP contribution room, and they're going to invest the exact amount they receive for CPP back into their RRSP. So it's a neutral tax situation. They're going to pay tax on the CPP earnings and get that back on the RRSP contribution. So it's a net neutral on taxes. What rate of return do we have to get? How does this look? So let's jump into that and let's break down the numbers. Before we jump into the numbers here, if you haven't already subscribed to the channel, hit the subscribe button below. It takes 1 second. It costs you nothing. And at the end of this video, if we provided value, if you find these videos helpful, make sure to hit the thumbs up button. It really does help get our videos out and through to the YouTube algorithm. Hit more people, and more people can learn this content. And just the more Canadians that can retire and make better decisions entering into and through retirement, the better off we all are. So, share this video, hit the thumbs up, subscribe if you're not already subscribed. Let's jump into the content. Okay, so jumping into the content here. So what you're looking at here are Tom and Sally Smith. So as you can see, 70,000 income. This is Sally. She's 59 years old, earning $70,000 a year. She has money in both RRSP and TFSA. No more contributions, and she's retiring at 65. Tom, the exact same situation, same income, 70,000, same amount of RRSP and TFSAs. If we go to a combined view here, so this is basically saying, they're not putting any more money in, but when they retire 65, between taking their CPP, their old age security, and drawing down on their RRSPs and TFSAs, they're going to average $76,930 from age 65 all the way down to age 95, which we assume death at 95. Okay, so $76,930. This is taking CPP at 65, okay, at 65, and not looking at taking it early. So this is kind of the default option. So again, $76,930. So now let's jump into what happens if Tom and Sally took their CPP a little bit earlier. And here you can see the same numbers. We haven't changed anything other than starting CPP at 60. So the amount's been reduced accordingly. And this is Tom. Sally's the same number. So we've assumed a 70% CPP. But again, we're comparing apples to apples. So if it's 70 or 100, it's the same reduction at 60. So at age 60, Tom receives $6,625 annually. And again, we're putting that money into an RRSP. So again, we're saying he receives $6,625 at age 60, but we're not taking it and spending it. We're going to reinvest it. How does that look compared to just delaying it till 65? So that's really what we're looking at here. So as you can see, 5 years, he's reinvesting that. If we jump over to Sally, it's the same situation. So same number, same reinvestment. So nothing changes there. So now they've taken it at 60. they've reinvested it, and we're assuming a 5% rate of return. Inflation at 2, rate of return at 5, and also CPP increasing at 2%. So those are the numbers we're working with. So looking at an average 5% rate of return, we're going to see income, after-tax income through retirement, adjusted for inflation, net income, $73,641. So again, CPP at 65 was $76,930. In this situation, we're at $73,641. So a big drop. Okay. And again, this assumes 5% rate of return, because I know a lot of you are going to leave a comment saying, well, 5% is too low. And some of you are saying, where do we find 5%? Okay. This is just a rate of return that we use for most of our projections. We think it's a conservative to balanced investment portfolio. We're comfortable with 5% average rate of return over a longer period of time. Again, so what's it going to take to kind of equal the CPP at 65? Like, what kind of rate of return do we have to get? Because I think that's really the difference. Okay, so if we jump back into the data here, what I'm going to do is actually switch over to a different scenario where I've run the rate of return in years 60 to 65 at 7%. Okay, so the same information. So jumping back into this here, income for Tom and Sally is $70,000. They're retiring at 65. They have a bit of RRSP and TFSA right now. As you can see, the only difference I've changed here, you see your CPP coming into your investments, into the RRSP. I've changed that rate of return for those 5 years only to 7%. So basically we're saying from age 60 to 65, we're going to reinvest our CPP. And for those years, we're going to have to take a bit more risk. We're going to have to average, net of fees, 7% rate of return. If we look at that for both Tom and Sally doing the same thing, we come out with roughly the same numbers, $76,445, which is about $500 less than just taking CPP at age 65. So here's my thoughts and my feedback and my challenge to you. Yes, taking CPP at 60 is an option and investing it, okay? That's a great option. It gets the payment started. You feel like you paid into this for a long time. Now you're getting something out. I get the psychological part of it. I need to make sure I get something out of it. But at the end of the day, when you enter retirement, you want to maximize your income, lower taxes as much as you can, create strategy. And, unless in this situation, let's say you're averaging that 5% rate of return, which, trust me, I know, some of you watching this video saying, oh, I'm getting 10 or 15%. That's rare, and that's not going to happen consistently. So, we do see, especially as you enter retirement, 5% is a very standard rate of return. Obviously we like to see more, but I like to plan off 5 and be conservative. So in this scenario, what we're saying is you're going to actually have to increase risk to get that 7% rate of return for 5 years leading into retirement. And that's not just on the deposits of CPP, that's on your whole RRSP account, which in this case for this couple is over $600,000. So, in the strategy with the numbers I'm using, it would mean that you'd have to increase the risk, your investment risk, to get a higher return on your RRSP account, which is the majority of your assets, in the 5 years leading to your retirement. I don't know if that's a great strategy to have, okay? If you're consistently averaging 7, 8, 9% in your investments, good on you. Maybe this strategy makes more sense for you. But if you're someone that's more of a conservative balanced investor, you're getting that 5 to 6% rate of return average over the years, you're happy with that, that's all you need to reach your retirement goals, there's no need to take more risk. A strategy like this may not be a good fit for you, okay? If you're someone that has an appetite for risk, you've averaged a much higher rate of return, then this strategy may make a lot of sense for you. Because again, if you're earning more than 7%, then your income is going to actually be higher than delaying till age 65. Okay, so those are kind of the numbers. So I wanted to break that down. A lot of you have asked about this. Does it make sense to do? There's really two buckets here. It makes sense if you're comfortable with more risk in your investment and you're going to average more than 7% rate of return. If you're going to average less than 7% rate of return, the numbers don't add up. So that's the difference. And again, is it worth taking more risk in your last 5 years before retirement? I don't think it is. Leave that risk to the government. I get that you're not taking your CPP and there's a downside to that, on the psychological side. But at the end of the day, we're trying to maximize income for you in retirement. And taking CPP earlier if you're not willing to take more risk in your investment, doesn't make a whole lot of sense. So again, like to break that down for you. Hopefully that gives you kind of more insight on how we do planning, how we look at this. Because at the end of the day, a lot of you I talk to get advice from neighbors, friends, could even be someone at the bank or your financial institution. And it's, am I okay to retire? And it's yes or no, right? That's not really a good answer, yes or no. I like to see the numbers and the data and strategy behind it. So if you're sitting there and thinking, can I retire? Should I take CPP at 60 and invest it? Should I wait till 65? Should I wait till 70? Maybe you have the assets and you can probably retire, but what does it look like? What does, good strategy look like? Give us a call, book a call with us, or send us an email, info@parallelwealth.com. We're happy to connect with you. We do offer fee-for-service financial planning. So if you're a DIY investor, or even, we talk a lot of you that are, at the banks or other big financial institutions that just aren't getting the planning. Maybe your advisor said, yeah, you can retire, you'll be fine, but you don't have the data to back it up or even the strategy to reduce taxes. So I would say on average with our plans that we're doing for our clients right now, we can see, I had a call with someone yesterday. He said, this sounds great, Adam, but is your fee offset by the savings I'm going to receive? So I said, you know what, I'll run a quick scenario and we'll see. And it worked out to $212,000 in taxes saved just on some basic planning stuff. So, having a proper plan can save a lot of money and just give clarity around stuff like this. Should you take CPP at 60, 65, or 70? If you take it earlier and invest it, doesn't make sense. Again, every situation, everyone's different because your appetite for risk on your investments will be different. And that's really a big deciding factor in this situation. So again, hopefully this helped you move forward with your CPP, what to do when you hit 60 or 65 or 70. And if you have any more questions on it, leave it below. We'll try to answer all those. Thanks for joining us in this video today. We'll see you in the next one.